welcome back to Watching Business Morning here on Channels Television. And as we told you, the price of Brent went up. I think this Tuesday when we're having this conversation with Dumebi, it was about 75, 76, so thereabout. Today is past 80. It's good for Nigeria, but let's find out if that the cooling of inflation in the United States is a major driver of this. Dumebi Oluwale is here. Hi, Dumebi. Good morning.
Good morning. Good morning.
So, I mean, imagine if you had invested some money in oil. From Tuesday till now, you make at least $5. I mean, you just take profit and walk out.
Good news for investors then.
Bad news for buyers.
Good news for investors then, and good news for exporting countries.
Like Nigeria, if we can boost our production.
Yes, yes, that's the caveat.
That's the caveat there. But I mean, what's the major, was it the inflation of yesterday?
Well, not only that, Saudi Arabia as well, they're sticking to their production cuts, extending it up until August. So
they are cutting 1 million.
1 million.
Russia is cutting 500,000.
Yes. So that tight market supply, side by side with cooling inflation in the U.S., has was what really drove the increase in oil prices today. And that's one of the reasons why this is really significant, because we're entering into the second half of the year. We're already in the second half of the year, and the expectations are that this tight oil supply might outweigh low Chinese demand, at least for the beginning of the first half of the year, because markets are still weighing the decline, the slowdown in the Chinese economy against supply shocks to oil. So it's still very shaky as usual. Oil prices are very volatile. So many factors affecting oil prices today. So,
all right. So this U.S. inflation obviously is good news, and I was hoping that it will come close home. But because going from 3%, I mean 4% to 3%, that's a whole 1%. Within a month. If it was Nigeria, you know how we are. We'll ask a lot of questions to say, are we sure that these numbers are really correct? Do they really? Because if you talk about 1% drop in prices, it's actually very significant.
Exactly.
And we expected. I wish I'd remembered. I would have spoken to somebody in the US. I think I've spoken to somebody in the US recently to find out how much it has reflected in their everyday buy. Because 1% within a month is a huge jump in inflation.
Yes, you're very right about that. It's extremely significant for people in the United States, especially because the pressure on consumer disposable income is significantly lower now. So what this simply means is that prices of commodities are cheaper for people. Rent, because with the increase in interest rates, with the increase in commodity prices, significant people have cost of living has significantly increased, and we know there's also the pressure coming in from oil prices and all of that. So right now, what we're seeing is that this the U.S. Fed's consistent increase in interest rates are beginning to at least crack down on inflationary pressures. And one of the main things that one of the main sub indices of inflation that the U.S. Fed really uses to track inflation is core inflation, which cancels out all the noise from food and diesel, food and energy prices. So essentially, in June, core inflation declined, or at least it moderated from 5.3% to 4.8%, meaning that the interest rate increases are beginning to at least have some significant impact on inflationary pressures. So what this means is that one of the reasons why market sentiments are a bit strong, it's that it might influence the Fed's decision to continue its temporary pause, at least also sustain the temporary pause on interest rate hikes, at least in the meantime. And with what has happened with inflation coming down, what we eventually saw was that the US dollar as well lost some steam, and that was able to at least provide some level of relief to other basket of currencies and
make some of global commodity prices cheaper.
Exactly, and make commodity prices as well cheaper for countries for heavily importing countries, because now most commodities are priced in the US dollar, and this temporary relief will be good for countries.
So I wanted to say if there are lessons we could learn from that to get our inflation down, but I think it's majorly interest rate hike that they've been doing, which is what we have been doing, but obviously that doesn't have the same effect because the cost of our inflation is different from what is causing their own inflation.
Yes, you're very, very right about that because those are, for Nigeria and the US are extremely two different economies as it is. The only thing is that the things that link us together right now is the fact that Nigeria's currency is pegged against, is pegged against the US dollar, and we have to do things to mirror what happens in the US so that investors don't bet against the Nigerian economy, don't bet against our currency, especially when interest rates have been rising in the US and the US dollar has been getting, has been strengthening over the past few months since the interest rate cycle has continued. But bringing the conversation to Nigeria, the reasons why the response in interest rates, the response of Nigeria's Monetary Policy Committee might be different from that of the US is because first of all, our inflation stoking factors are very different. The structural factors that are affecting Nigeria's inflation, and aside the monetary factors, because in theory you have that inflation is too much money chasing too few goods, but when you break that inflation definition apart, you realize that first of all, where is the money coming from for people to spend to chase the too few goods that are currently existing? Then two, you also look at the consistent increase in commodity price. So people first of all are not earning enough, and number two, people are not also demanding so much simply because the price of these commodities are higher. Then you now look at the other structural factors like insecurity, causing food prices to be high, and all of that. Then the final thing is that our monetary policy transmission mechanism in Nigeria is also very weak. So that's why you see that there's a time lag for when the MPR is increased, and then other interest rates like interest on government securities, the treasury bills, bond rates as well, before you see all of that even tick up a little bit, because the monetary policy transmission cycle is that once there's an increase in the anchor rate, we should see all the other interest rates in the economy increase, so that we're able to mop up excess money supply in the economy. So it's essentially a mopping up. But in this situation, interest rates on those securities are not rising as fast. So the incentive to mop up supply, or the incentive of people to put their monies in the bank is not so high, or to invest or exchange bonds for cash. It's not there. Savings rate has barely ticked up, and who really has the money to put in the bank to save?
Where does the devaluation of the naira get into all of this?
Well, when we look at the fact that, like I said, you have to also break this apart. So when we look at the exchange rate system in Nigeria, so there are so many factors that come into play. You have the issue with supply, you also have the issue with demand. Now, the exchange rate devaluation, one of the reasons how this comes into the inflation conversation is through import costs. So you have that manufacturers who want to import their raw materials, they have been getting interest rate at a more expensive rate, typically a blended rate. So they source about 90% from the parallel market, that's the black market, and then source the remaining 10% from the official market. And that blended market rate has always been more expensive than the official rate. So what this simply has done for them is just make these blended rates official. So really, nothing has changed so much in their import costs.
But the gap between the parallel market and the official rate, the gap between has reduced. So that should also reduce their cost, even if it's for a bit.
So you think of it this way. The parallel market, the official rate was 462. Black market was around 750. Let's use 750. The blended rate, that's somewhat like an average, was probably settling around 700, 702, sometimes 715 for these marketers. Now we're having an official rate of 750, 770, So really, what has happened is that their access, because it's two issues, the exchange rate that they're getting, which is the price, and their access to the official market. So what has happened now is that now all the manufacturers, most of the manufacturers that we're getting at the blended rates now have access to the official market. So the issue of access has, reduced, somewhat reduced. But the issue of price hasn't really changed much, because they were already using these blended rates.
And now the blended rate seems to be the official rate.
So that's exactly what has happened. So the price really hasn't changed. So that impact of the exchange rate pass-through effect to commodity prices is still there. Is still there due to import costs. And remember that while this desegmentation of the exchange rate has happened, yes, there's the conversation around easy access. The import restrictions on commodities are still there. So the conversation around having access to official markets, yes, is there, but smallest manufacturers still would have to source from the black market. Reason being that restriction on importation is still there.
It's still there, so you still have to go the other way to get it.
Exactly.
But all of this is supposed to make us sell more of our cocoa, because I mean, when a currency is devalued, then the commodities are cheaper, you know, and it's supposed to attract more market, more demand.
Yes, there's that aspect which is good for our trade balance. Nigeria's current account recently, moved into a surplus, so that's one good news, and those are some of the things that we could likely see, coming from this exchange rate devaluation that has happened. Our current account surplus, coming into surpluses, simply because now what we get in dollars when we convert into naira is a lot more. So, but like I said, like we agreed before, there's so many other structural factors affecting production of some of the agricultural raw materials that we export. For example, you look at there's the pod disease. You also look at the issues farmers experience while even planting. Insecurity is still a big issue. And while we're excited, okay, we're getting into almost like the peak of the rainy season and all, which might be good for cocoa harvest and all, there's still so many other factors to consider that these farmers have to go through before even getting their harvest out and then exporting.
All right. What about other commodities? What's happening to them?
Well, a very significant one, price of flour is up by about 5%, just because of, like we said, this issue with like importation, and then you also have
so
like
increased operating costs.
Exactly. So issues with operating costs and the global price of wheat is still quite high for manufacturers to also import. Then down the value chain, you look at how the increase in the price of flour is affecting other commodities.
Yeah, I heard bread is going to go up about 15%.
Exactly. so then you see that there's that chain reaction, happening from what is happening globally. Then you have the issues that manufacturers experience in terms of like the high energy costs. The petrol, the fuel subsidy removal has significantly increased their operating expenses. Then you also have the exchange rate devaluation as well. And like I said before, these import restrictions are still there. So you have all of this coming into play, still keeping their operating costs high and affecting commodity prices.
And the Black Sea grain deal, it's 18th. It expires on the 18th. Doesn't look like there's going to be renewal. Should we expect significant spillover effects into Nigeria?
Well, there are two ways. We've had incidences of this Black Sea deal just getting very close to the time, and then
something good eventually, it was like
something good eventually happens, and then Russia says, okay, you know what, I'll continue. So there's a chance of that still happening, just to keep commodity prices moderate, because the United Nations, the World Bank, everybody is just trying to keep inflation, low. Then you also have the fact that just in the event that this doesn't happen and commodity prices go up, so this will significantly impact the price of commodity of durum wheat that Nigeria significantly imports, and then the price of flour, and then the price of bread and other
I'll stop
commodities.
Eating bread.
But really, what other alternative? Yam?
Yeah.
Well, true.
It's local. We'll go back home.
Cassava, I guess.
Cassava bread.
Well, maybe. Yeah.
All right, Jumebi, thank you so much. Thank you for your time and your perspective this morning.
Thank you.
All right, that's it on the commodity segment. Looks like we have some hard days coming ahead, but I mean, we'll see how it goes and we'll make it through. Let's take a break now. When we come back, another conversation awaits you on the other side of Business Morning.